Committee meeting for the 31st of January. Mr. Samario, are you going to start us off? Okay. Ms. Nemes?
Good afternoon, Chair Hart, committee members. I am Julie Nemes. I'm the Treasury Manager for the Finance Department. Today I'll be going over the investment report for the quarter ended December 31st, 2016. There are 5 areas I will be covering today. First, I'll be going over a little information on the interest rate environment and current economic conditions. After that, I'll be covering the city's investment strategy and approach. Third, some information on long-term trends, including earnings and interest rates. Fourth, I'll be covering some benchmarks and comparing our performance versus some benchmarks. And last, it'll be the summary of the quarter's investment performance and activity. So first of all, a little information on the interest rate environment. As you may recall, in December 2015, the Federal Reserve increased interest rates by 0.25. They hinted at additional increases in 2016. However, we didn't see another one until December 2016, where the Federal Reserve increased the rates again by 0.25. There were several reasons that the Federal Reserve gave for this increase. They stated that they had some confidence in the U.S. economy now and that they felt that there would be future growth out into 2017. The unemployment rate is down now to 4.6%, which is the lowest since 2007. They also stated that they were seeing signs of stronger wage growth. Wage growth was up a little bit in the fourth quarter, and they were seeing signs that in 2017 it was going to grow even higher. And they were finally seeing inflation starting to pick up and get close to that 2% target that they set. The Federal Reserve really has 2 targets for raising interest rates, and that is the 2% inflation target, which is price stability, as well as full employment, so a low unemployment rate. So what does this mean? Overall, as of the end of the quarter, Treasury rates are up, but they still are relatively low. The 5-year is inching up to that 2% range. As of 12/31 compared to September 30, we saw rates higher for all maturities, with 10-year having the largest gains of about 85 basis points. The Federal Reserve, at the December meeting as well as throughout 2016, has hinted at additional interest rate increases in calendar year 2017, as many as 3 increases, but it's all going to depend on changes in the economy throughout the year. And I did also want to mention that these higher interest rates, they do impact Treasury yields, but also they enable the Federal Reserve to make any cuts in the future in case there's a recession to help stimulate the economy. So what are any changes in economic factors since the quarter that may impact rates? So we're still seeing global uncertainty, economic uncertainty in both Europe, Asia. It's having an impact on our exports. We're seeing weak foreign demand for our U.S. exports. We're also seeing a low annual GDP. For 2016, it was about 1.6% compared to 2.5% for 2015, and it's the lowest that it's been for several years. We're seeing a slight increase in consumer spending. We saw some increases in the quarter for auto sales. We're seeing some lower spending on brick and mortar, but some increases in internet sales. As I mentioned, the unemployment rate is down. It's still around 4.6, 4.7%, and we're seeing that moderate wage growth. Inflation continues to approach that 2% target. It is now up to about 1.6, 1.7%. And the last is unknowns regarding presidential policies. There's a lot of unknowns related to any policies that might be put in place in the next year and how the Federal Reserve may react to those policies. Again, we mention this every quarter, but even with these higher rates at 12/31, it still takes several years until we have any material impact on our interest earnings. We have to wait until those investments are called or mature before we can buy back into the market at the higher rate. So it does take several years. This chart is a summary of the interest rates, the Treasury rates at 12/31 compared to 9/30 and the months in between. As I mentioned, all of the rates for all maturities are up at 12/31. We generally invest in 1 to 5 year maturities, and those rates range from 0.85 to 1.93 at 12/31, so some pretty significant gains compared to 9/30. I did also want to mention that LAIF, which is what we consider a liquid balance, that has been continuing to increase every quarter for, I think it's been about 2 years now. So a little information on our investment strategy and approach, and this is a reminder that we go over. It's related to our investment policy. Our primary objective is safety first, then liquidity, and then yield. Our policy is to preserve principal, then meet the cash needs of the city, and then earn a fair rate of return. We buy into the market. We don't chase the yields. Our investment approach is passive. We do hold to maturity. And our attempt is to maintain a steady maturity over a 5-year period. And we do this to make sure we have adequate liquidity to meet all the cash needs of the city for any large projects or any other needs. And also it helps us to prevent us from investing too heavily in a bad interest rate market and allow us to invest when rates do go up. We have money to invest when rates go up. So the next couple slides are some charts and comparisons to benchmarks. This first one is a comparison of our portfolio rate to the 2-year Treasury, the 5-year Treasury, and the LAIF rate. The portfolio rate is blue, the 2-year is red, the 5-year is purple, and the LAIF rate is green. So what's important about this is the benchmark serves as an indicator of the city's performance. If we saw a lot of deviation between the city's rate and the Treasury rates, there would be some cause for concern. We need to look into it further. The one thing I wanted to point out is because the city invests in different terms and different types of investments, there is a more stability in the portfolio rate. So as the Treasury rates drop, the portfolio rate doesn't drop as quickly. Same thing is true on the alternate side. As the rates increase quickly, the portfolio rate does not increase as quickly. So in the last quarter, you'll see at the end of the chart, both the 2-year and the 5-year have those sharp increases for the last 3 months. The portfolio rate is increasing, but not at the same pace. There is a timing difference, and it also, because of that stability, it doesn't raise at the same level. So at the end of 12/31, the city's portfolio rate is below the 5-year and just slightly below the 2-year by a couple basis points. I like to provide this yield curve every time because it gives you an idea of what kind of rates we would be able to get if we invested in the market today. This is the Treasury yield curve as of yesterday. So I wanted to point out that the rates are very similar at 1:30 to what they were at 12/31, other than the 1-year, which is down about 8 basis points. All of the other from 2-year to 5-year are within 1 basis point of where they were at 12/31. So moving on to the quarter performance for the portfolio. The total portfolio yield did increase this quarter. As I mentioned, it went from 1.119% to 1.176%. It's a little bit of an increase. The interest earned during the quarter is a little over $407,000, of which the general fund received $98,000 of it. Our total portfolio, cash and investment portfolio, did increase about $23 million from $141 million at 9/30 to $164 million at 12/31. There's a couple of reasons for that. Some of it is the time of year. This is the time of year we receive property taxes. So we had a lot of money come in for property taxes. Also, we received some DSAL state reimbursements. And the third reason is sales tax. The end of the triple flip occurred last year during summer. We received a one-time payment as a true-up for the triple flip ending, which is about $2.5 million. Also, we now receive higher monthly payments in sales tax that used to be paid through property taxes. So it's purely a timing difference. It's the same amount of money. So when the triple flip was in place, a quarter of the Bradley Burns tax was paid through property taxes instead of through our monthly sales tax allocations. So now we are getting higher monthly sales tax allocations rather than waiting to receive that through the property tax payments that come between November and April. So it's purely just a timing difference. So we have more cash on the front end.
Mr. Chair,
Yes, Councilmember White.
I don't understand that. Triple flip, transfer from property tax to sales tax, did you say?
From sales tax to property
Sales
tax.
tax to property. Could you explain those two pieces?
Sure.
Walk through them
So
a
I
little.
believe it was in 2004 that they originally passed the state to pay back bonds. They were taking 1/4 of the 1% Bradley Burns tax that the city receives, and they were taking that to pay back the bonds, but the city loses no money. Instead, they get the money back through property taxes. And it comes from school districts and other agencies that then are backfilled because they have a minimum guarantee. So end of all of it is none of the local agencies lose any money. It's just a shifting of revenues and a timing of them. So at the end of the year, everybody receives the same amount of money, but it's through different revenue shifting streams and timing. So instead of us getting the sales tax, the full 1% estimates every month, we get 0.75, and then we got it through property taxes throughout the year, the makeup, if that makes sense. I'm not.
I think I understand what you're saying.
Okay.
It doesn't. It sounds arcane and complicated, and I'm not sure just why.
But it is over. So the triple flip ended last year, and now we're just receiving our full share.
Committee Member White, the reason the state wanted to be able to take sales tax dollars for purposes of selling bonds, the sales taxes are considered a secure form of revenue stream. They had no other means of doing that. So by taking our share of sales tax dollars, they were able to get a better deal and secure better financing in the bonds they wanted to sell. So they basically took our share and they give it back to us through property taxes, but it helped them in the selling of bonds.
That makes sense.
Thank you. So this next chart is a summary of our investment activity for the quarter. The city had $18 million in purchases for the quarter. 12 of them are in federal agency securities with a call feature. 6 million of them are federal agency securities with no call feature, what we refer to as a bullet. In the same quarter, we had $9 million in federal agency securities that were called, $2 million that matured. We had another $2 million in money market funds that matured. And the last item on there is $146,000 semi-annual principal payment on the airport promissory note. So the net effect of all of this is $4.8 million that we spent out of our checking account to buy more investments than what came back to us. This next chart is a summary of our investment portfolio at 12/31, so it's a snapshot of what we have in the portfolio at December 31st. As I mentioned, the portfolio has increased about $23 million since 9/30 due to several of the issues that we just spoke about. The majority of that is in our what we call our liquid balance. That's the checking account and the LAIF balance, about $20 million of it. The remainder is in investments that we have purchased. Part of the reason why that's in cash is due to some additional cash needs we've had, but we also have already put $16 million of that back into the market. We've bought $16 million of investments that have settle dates in January and February. Because we received so much cash in fall, we turned around and tried to put that back in and into our maturity ladder to fill some of those holes. This is a different way of looking at our portfolio at 12/31. It gives you an idea of what we are invested in and how we are diversified. We have about 37% in agencies, 1% in treasuries, 4% in CDs, 6% in corporates. We have 5 different corporates. 3% is the airport note, and then we have about 49% in what we call our liquid balance, LAIF and the checking account. As I mentioned, $16 million of that has already been put back into investments. We bought primarily Treasury, federal agency securities with that $16 million. I believe we also purchased a Treasury. And so it gives you an idea of how we're diversified. However, we are maintaining a slightly higher cash balance than we normally would due to some rather large projects with the city, such as DSAL.
What are agencies?
Agencies are federal. They are not. Agency securities are not backed by the U.S. government, but they're sponsored by the U.S. government. So they're such as the Federal Home Loan Mortgage Association, their National Bank, Home Loan Bank. So they're agencies that are associated with the federal government, but not 100% backed by them. So they're considered very safe, but they're not as safe as treasuries, which are 100% backed by the U.S. government. And that takes me to our recommended action, which is that we are asking that you recommend that council accept and approve the second quarter investment report and the fiscal agent report. Thank you.
Thank you for the excellent report. Any questions from council members? Okay. Are there any members of the public who'd like to speak on this item? Okay. Then if there's a motion from the committee?
I move the staff report.
Is there a second?
Second.
All those in favor say aye. Aye. And opposed? No. And no abstentions.
And
Thank
just a
you.
reminder, this is on consent on today's council
Okay.
agenda.
Thank you both.
Thank you.
We are adjourned.